A man doesn't make money by trading all the time. That's the first thing you must understand. He makes money by sitting still, by deciding when not to act just as much as when to act. Now tell me, how often do you feel the urge to be in the market just because it's moving? That urge, that's not opportunity. That's impatience dressed up as ambition. You see, deciding whether to enter a trade isn't a question of courage. It's a question of evidence. The market is always speaking, but it doesn't shout. It whispers. And if you haven't trained yourself to listen, you'll mistake noise for meaning. So before you even think about placing a trade, you ask yourself, what is the market actually doing? Not what you think it should do, not what you want it to do, but what it is doing right now. When a stock, or any instrument, moves in a clear direction, it leaves footprints. Higher highs, higher lows, or the opposite. Strength follows strength, weakness follows weakness. That's not opinion, that's behavior. Now here's the question. Are you entering because you see that behavior clearly, or because you're afraid of missing out? Because when a trader enters out of fear of missing out, he is no longer making a decision. He is reacting, and reaction is expensive. Let me tell you something plain. The market does not reward anticipation nearly as much as it rewards confirmation. You don't need to catch the bottom. You don't need to catch the top. What you need is the middle, the part where probability is on your side. But how many traders skip that and try to be clever instead? And what follows when they do? Losses, not because they're unlucky, but because they're early. Timing is not about speed. It's about alignment. So before entering a trade, you wait for alignment. Price, trend, and behavior must agree. If they don't agree, you don't have a trade, you have a guess. And a guess is not a strategy. Now ask yourself honestly, are you trading a setup, or are you trading a feeling? Because feelings don't pay. Here's something else most men overlook. A good trade feels almost obvious after it has already begun. It doesn't beg you to jump in. It doesn't rush you. In fact, it often feels like you're late. But that's the paradox. Being late to a confirmed move is often safer than being early to an uncertain one. Why? Because when a move is confirmed, other traders are already committed. The weight is there. The direction has meaning. When you enter before that, you're stepping in front of the crowd, not with it. And the market has a way of punishing those who stand in the wrong place at the wrong time. Now let's bring this down to something practical. Before you enter any trade, you should be able to answer 3 simple questions, not in theory, in certainty. First, what is the trend? Not what it was yesterday, not what you hope it becomes, but what it is right now. If you cannot define the trend clearly, you have no business entering. Second, where is the risk? Not just a vague idea, but a precise level. If the trade goes against you, where are you wrong? Because if you don't know where you're wrong, you'll stay wrong longer than you should. Third, is there a reason for this move to continue? Momentum, volume, structure, something must justify continuation. If there's no reason for continuation, then what are you really betting on? Now think about it. How many trades have you taken where you couldn't answer all 3? That's where most losses are born. Not from bad luck, but from incomplete thinking. You see, deciding whether to enter a trade is less about finding opportunity and more about eliminating uncertainty. You're not looking for reasons to get in. You're looking for reasons to stay out. And when you can't find enough reasons to stay out, then you have something worth considering. That's discipline. And discipline, not intelligence, is what separates the consistent trader from the hopeful one. Another thing, you must learn to recognize when the market is offering you nothing. Sideways movement, choppy behavior, conflicting signals, these are not invitations. They are warnings. The market is telling you, there is no edge here. But do traders listen? Rarely. They trade anyway. And what happens when you trade without an edge? You pay tuition. The market always collects from impatience. Now consider this. When you wait for a clean setup, your mind is calm. Your decision is clear. But when you force a trade, your mind is already uneasy. You start managing the trade emotionally instead of logically. You move stops, you hesitate, you second guess. Why? because the trade was never solid to begin with. So the real decision isn't just whether to enter. It's whether you have the right to enter, and that right is earned through observation. A seasoned trader doesn't chase the market. He studies it. He lets it reveal itself. He waits for repetition, for patterns that have proven themselves over time. Because when a pattern repeats, it carries memory. And memory in the market, that's where probability lies. But let me ask you this. Are you trading patterns you understand, or patterns you just recognize? There's a difference. Recognition is quick. Understanding is earned. And only one of them will keep your capital intact. You must also understand your own condition before entering a trade. Are you clear-headed? Are you patient? Or are you coming from a place of frustration, trying to recover what you've lost? Because when a trader enters from frustration, he is not trading the market. He is trading his own emotions, and emotions don't follow charts. They follow impulses. So you pause, you step back, you observe not just the market, but yourself. Because the state you're in will determine the decisions you make. And decisions, they compound. A good decision leads to another good decision. A poor one leads to a chain of mistakes. Now, when all the pieces align, trend, structure, confirmation, risk, there's no hesitation. That's important. Waiting doesn't mean doubting. It means preparing. And when the moment comes, you act without fear, because the decision has already been made through logic. That's how a professional approaches the market, not with excitement, not with urgency, but with clarity. Because in trading, the money isn't in the activity, it's in the accuracy, and accuracy comes from patience. So the next time you're about to enter a trade, pause for a moment and ask yourself, is this the market offering me an opportunity, or is this me trying to force one? A trade is valid only when behavior confirms direction, not when opinion suggests it. That may sound simple, but most traders never truly understand it. They believe the market should move a certain way, so they position themselves before the market has agreed. Now ask yourself, how many times have you entered a trade because it looked like it should go up or down, only to watch it do the opposite? That's the cost of trading opinion. The market doesn't move because something makes sense to you. It moves because of collective action. Buyers stepping in with conviction, sellers stepping out with urgency. That action leaves evidence. Price doesn't lie. It shows you where strength is building and where weakness is taking hold. But here's the key. Evidence comes before entry, not after. When a trader forms an opinion first, he becomes attached. And once he's attached, he stops observing clearly. He begins filtering information to support his view. If price moves against him, he explains it away. If it hesitates, he calls it a pause. And what follows from that kind of thinking? Losses that could have been avoided simply by waiting. Behavior, on the other hand, has no bias. It is what it is. If a stock is making higher highs and holding those gains, that's behavior. If it breaks resistance and continues without hesitation, that's behavior. If volume increases as price moves, that's behavior. These are not guesses. They are signals. And when these signals align, they confirm direction. That's when a trade becomes valid. Now consider the opposite. A trader sees a stock that has fallen sharply. He thinks, it's too low, it has to bounce. That's opinion. But what does the behavior say? Is it still making lower lows? Are sellers still in control? Is there any sign of accumulation? If the answer is no, then the trade is not valid, no matter how logical it seems. The market does not reward logic alone. It rewards alignment with reality. And reality is found in what the market is doing, not what you believe it should do. So the question becomes, are you reacting to facts, or are you acting on assumptions? Because assumptions are dangerous. They create trades without foundation. And when a trade has no foundation, it cannot withstand pressure. The moment price moves slightly against you, doubt enters. You hesitate. You question. You start managing the trade emotionally instead of structurally. All of that begins at the point of entry, when you chose opinion over confirmation. A trader who waits for confirmation operates differently. He doesn't need to predict. He observes. He lets the market prove itself. And when it does, his entry is not based on hope. It is based on evidence. That changes everything. Because when your entry is backed by behavior, your confidence is stable. You know why you are in the trade. You know what should happen next. And if it doesn't happen, you know you are wrong. There is no confusion. But when your entry is based on opinion, you are always uncertain. You are always interpreting. You are always adjusting your story to fit the price. And that kind of thinking keeps you inconsistent. Now think about this. What follows when traders act on opinion? Early entries, weak conviction, unnecessary losses. And what follows when traders wait for confirmation? Fewer trades, stronger positions, clearer outcomes. So the difference is not just philosophical, it is practical. It affects your timing, your risk, your execution. And yet most traders resist waiting. Why? Because waiting feels like missing out. It feels like inactivity. But inactivity, when it is intentional, is not weakness. It is control. The market will always offer another opportunity, but it will not always offer a clear one. And your job is not to trade every move. It is to trade the right ones. So before you enter, you pause and ask yourself, has the market confirmed this move, or am I trying to get ahead of it? Entering without defined risk is not trading. It is exposure without control. And control is the only thing a trader truly has. You don't control the market. You don't control the outcome. You don't control the timing of moves. So what do you control? Your risk. Now let me ask you. If you enter a trade without knowing exactly where you are wrong, what are you really doing? You're hoping. And hope has no place in this business. Every trade begins with a question, not of profit, but of loss. Where does this idea fail? At what point does the market prove me wrong? Because if you cannot answer that before entering, then you have already surrendered control. You've handed your decision, making over to emotion, to hesitation, to the moment when price starts moving against you. And that moment always comes. The market doesn't move in straight lines. Even the best trades test you. They pull back, they shake, they create doubt. Now imagine you're in a trade without a defined risk. What happens when that pullback begins? You don't act. You freeze. You tell yourself to wait. You convince yourself it will come back. And while you wait, the loss grows. That's how small mistakes become large ones. But when risk is defined, the situation changes entirely. You already know the point where the trade is invalid. You don't need to think in the moment. You don't need to negotiate with yourself. The decision has been made in advance, and that removes emotion from execution. Now consider this. Why do traders avoid defining risk? Because it forces them to accept being wrong. And most people don't like being wrong. They delay that acknowledgement. They widen their stops. They give the trade more room. But what they are really doing is avoiding discipline. And what follows from avoiding discipline? Losses that are bigger than they should be. Defined risk is not just about protection. It is about clarity. It tells you whether the trade even makes sense. If you cannot find a logical level where the trade is invalid, then the setup is not clear enough. And if the setup is not clear, why are you entering? A good trade offers both opportunity and structure. It shows you where to enter, and just as importantly, where to exit if you're wrong. Without that structure, you are navigating without boundaries. And in a market that moves without warning, that's a dangerous place to be. Let's make it practical. Before you enter any trade, you should be able to point to a specific level on the chart and say, if price reaches here, my idea is wrong. Not uncomfortable, not inconvenient. Wrong. There's a difference. Because if you define risk based on discomfort, you will exit too early. But if you define it based on invalidation, you exit with logic. Now think about how that affects your behavior. When you know your risk, your position size becomes controlled. Your expectations become realistic. You're not trying to win big. You're trying to trade well. And when you trade well consistently, the results follow. But when risk is undefined, everything becomes distorted. You hold losers too long. You cut winners too early. You lose balance. Why? Because you never established the boundaries of the trade. And trading without boundaries is not strategy. It is exposure. Ask yourself this. Are you deciding your loss before you enter, or are you discovering it after the market moves against you? Because those two approaches lead to entirely different outcomes. One leads to controlled losses and long-term survival. The other leads to emotional decisions and eventual damage. A professional trader doesn't enter because he sees opportunity alone. He enters because he sees a controlled opportunity. He knows what he stands to lose before he considers what he might gain. That order matters, because when loss is defined first, profit becomes a byproduct of discipline. And discipline, when repeated, builds consistency. When price, trend, and momentum disagree, the correct decision is no decision. That's not hesitation, that's judgment. And most traders mistake the two. They think doing nothing means missing out. But tell me, what exactly are you missing when the market itself is uncertain? You see, the market is only clear when its elements align. Price shows you where it is. Trend shows you where it has been moving. Momentum shows you how strongly it's getting there. When all three point in the same direction, you have something solid. But when they conflict, you don't have a signal, you have noise. Now think about how traders usually behave in that situation. Price starts pushing up, but the broader trend is still down. Momentum spikes briefly, then fades. There's movement, yes, but is there agreement? And if there's no agreement, what are you really trading? Confusion. And confusion is expensive. A trader who understands this doesn't rush in. He waits. Because he knows that misalignment leads to inconsistency. When price moves against trend, it often stalls. When momentum fades, moves lose strength. And when these factors pull in different directions, the result is choppy, unpredictable behavior. That's the kind of environment where traders get trapped. They enter on a small breakout, only to see it reverse. They short a pullback, only to see it bounce. They act on fragments instead of the whole picture. And what follows from that? A series of small losses that slowly wear down both capital and confidence. But the market is not forcing those losses. The trader is choosing to participate without clarity. Now ask yourself, why do traders take trades in unclear conditions? Because movement creates temptation. It feels like something is happening, so they feel they should act. But activity is not the same as opportunity, and recognizing that difference is what separates patience from impulse. When price, trend, and momentum disagree, the best position is no position. That's not passive, it's selective, because by staying out, you preserve both capital and clarity. You avoid the emotional swings that come from uncertain trades. You keep your focus intact for when the market finally aligns, and it always does eventually. Markets cycle between clarity and confusion, between trend and noise. Your job is not to trade every phase, it's to recognize which phase you are in. So how do you recognize misalignment? You look for contradiction. Price making higher highs while the overall structure remains weak. Momentum fading during what should be strong continuation. Breakouts that fail quickly instead of holding. These are signs that the market is not committed. And if the market is not committed, why should you be? Commitment in trading must be earned through evidence. Now consider what happens when alignment returns. Price breaks cleanly in the direction of the trend. Momentum supports the move instead of fading. Pullbacks are shallow, not deep. That's when the market becomes readable. That's when probability improves. And that's when a decision makes sense. But you only recognize that moment if you've had the discipline to stay out before it. If you've been trading every fluctuation, you're already distracted, already fatigued, already managing positions that shouldn't have been taken. And when the real opportunity appears, you're not ready for it. That's the hidden cost of overtrading in unclear conditions. So the decision not to act is not wasted time. It is preparation. It keeps you aligned with the market's rhythm. It allows you to step in when the conditions are right, not just when they are active. Because the market is always active, but it is not always clear. And clarity is what you are paid for. So the next time you see movement, pause and ask yourself, do price, trend, and momentum agree? Or am I trying to force a trade out of disagreement? The best entries feel patient, not urgent. That's something most traders learn the hard way. Because urgency feels exciting. It gives the illusion that something important is happening right now, and if you don't act, you'll miss it. But let me ask you, since when did good decisions come from pressure? Pressure clouds judgment. When a trade feels urgent, it usually means you're reacting to movement, not understanding it. Price starts moving quickly, candles expand, and suddenly your focus narrows. You stop thinking in structure and start thinking in speed. It's running, I need to get in. That thought alone has cost traders more money than any strategy ever could. Because when you chase urgency, you abandon position. You enter late, after the move has already extended. Your risk becomes unclear, because where do you place your stop when price is already stretched? Your reward shrinks, because much of the move has already happened. And then what follows? Either a pullback that tests your patience, or a reversal that punishes your timing. That's the price of rushing. Now compare that to a patient entry. A patient entry doesn't feel dramatic. It doesn't demand your attention. In fact, it often feels almost uneventful. Price has already shown its direction. The trend is established. The behavior is consistent. And instead of chasing, you wait for a controlled moment. A pullback, a pause, a level where risk can be defined. That waiting, that's where the edge is. Because patience allows you to enter with structure. You know where you're wrong. You know what should happen next. You're not guessing. You're aligning yourself with what the market has already proven. And here's the interesting part. Patient trades often feel slower at the start. They don't explode immediately. They build. They progress. And that progression keeps your mind steady. You're not reacting to every tick. You're following a process. Now think about your own trades. How often have your worst entries felt urgent? And how often have your best ones felt calm? There's a pattern there. Urgency is usually tied to fear. Fear of missing out. Fear of being left behind. Fear of not participating. But fear is not a signal. It's a distraction. And when you trade from distraction, your decisions lose clarity. Patience, on the other hand, is tied to confidence. Not blind confidence, but confidence built on observation. You've seen the setup. You've waited for confirmation. You've allowed the market to reveal itself. So when you enter, there's no rush. There's only execution. And execution, when it is calm, tends to be precise. Here's something practical. When you feel the urge to enter quickly, pause. Don't act immediately. Give the market a moment to continue without you. If it keeps moving cleanly, it will offer another opportunity. If it doesn't, then you've just avoided a poor entry. That simple pause can change everything. Because it separates impulse from intention. Another thing to understand, markets don't move in a straight line for long. Even strong trends have pauses. Even powerful breakouts have retests. And those moments of pause are where patient traders position themselves. Not at the peak of excitement, but at the point of control. Now ask yourself, are you entering where the market is extended, or where it is structured? Because structure gives you balance. It gives you a clear place for risk and a logical path for price to follow. Urgency gives you none of that. It puts you in the middle of movement, without context, without control. And without control, you are exposed. A seasoned trader doesn't feel the need to catch every move. He knows that opportunities repeat. That market cycle. That missing one trade is irrelevant if you are prepared for the next. But a trader driven by urgency believes every move is the one that matters. And that belief leads to overtrading. Overtrading leads to mistakes. And mistakes, repeated, lead to losses. So patience is not just about waiting, it's about filtering. It's about allowing only the clearest opportunities to pass through. It's about recognizing that not every movement deserves your attention, and certainly not your capital, because capital is limited, and how you deploy it determines everything that follows. When you learn to wait, truly wait, you begin to see the market differently. You stop reacting to noise. You start recognizing rhythm. You see where others are rushing in, and you choose not to follow. And in that decision, you create space for clarity, for control, for better timing. Trading out of boredom creates losses disguised as activity. That's a quiet truth, but a dangerous one. Because boredom doesn't feel like a problem. It feels like nothing. And in that nothing, traders begin to look for something to do. Now let me ask you, since when did the need to act become a reason to risk money? The market does not care if you are bored. It does not reward participation. It rewards precision. And when you trade just to stay active, you step away from precision and move toward impulse. You begin taking trades that you would normally ignore, setups that are unclear, conditions that are messy, signals that are incomplete, not because they are good, but because they are there. And that's where the trouble begins. Boredom lowers your standards. A trader who is engaged waits for alignment, for confirmation, for structure. But a trader who is bored starts to compromise. This looks close enough. It might work. I'll just take a small position. These are not decisions. They are justifications. And what follows from justifying weak trades? Inconsistent results. You see, boredom creates a false sense of opportunity. It makes normal market noise look like something meaningful. Small movements appear larger. Random fluctuations feel intentional. But the market hasn't changed. Only your perception has. And perception, when distorted, leads to poor judgment. Now think about what happens after you enter a trade out of boredom. You're not fully committed, because you know deep down the setup wasn't strong. So you watch it more closely. You react more quickly. You exit too early or hold too long. Why? Because the trade never had a clear foundation to begin with. There was no plan, only action. And action without a plan leads to reaction. That's the cycle. You take a trade to relieve boredom. The trade doesn't behave clearly. You start managing it emotionally. It ends poorly. Then you feel the need to make up for it. And suddenly, boredom has turned into frustration. Now you're even further from clarity. A disciplined trader understands that inactivity is part of the process. He doesn't measure his day by how many trades he takes. He measures it by how well he follows his rules. If the market offers nothing, he does nothing. And that nothing is not wasted time, it is preserved capital. Because every trade carries risk, and when you take trades without a reason, you are stacking risk without edge. Over time, that accumulation works against you. Small losses add up, confidence erodes. Focus weakens, all from trades that never needed to be taken. Now ask yourself, are you trading because the market is giving you a clear signal, or because you feel the need to be involved? There's a difference. The need to be involved comes from within. It has nothing to do with the market. It's a personal discomfort with waiting, and if you cannot sit with that discomfort, you will pay for it. Not all at once, but gradually, consistently. Here's something practical. When you feel bored, step away from the screen. Not for long, but long enough to break the impulse. Because boredom thrives in stillness without awareness. The longer you stare at a quiet chart, the more likely you are to invent reasons to act. Distance restores perspective. Another thing, define your criteria clearly before the session begins. Know what you are waiting for. That way, when nothing matches your criteria, you recognize it immediately. There is no debate, no second guessing. Just a simple understanding, this is not my trade. That clarity protects you. Because without predefined criteria, boredom fills the gap. It creates its own rules in the moment, and rules created in the moment are rarely good ones. A seasoned trader treats capital with respect. He doesn't expose it to unnecessary risk just to feel productive. He understands that not trading is often the correct decision, that the absence of opportunity is itself information, and information, when used properly, keeps you aligned with reality. Confirmation reduces uncertainty, anticipation multiplies it. That's not theory. It's the difference between controlled trading and hopeful guessing. Most traders believe they make money by being early, by seeing something before the crowd. But tell me, how often has being early actually worked in your favor? Being early feels smart. It feels like you're ahead of the move. But in reality, you're stepping into a situation that hasn't proven itself yet. You're acting on what might happen, not what is happening. And when you trade on what might happen, you introduce uncertainty into every part of the trade. Your entry, your timing, your conviction. Uncertainty is where mistakes grow. Now think about anticipation. You see price approaching a level. You assume it will break. You enter before the breakout happens. But what if it doesn't break? What if it stalls, or worse, reverses? Now you're in a trade that has no confirmation, no support, no follow-through. And what follows from that? Doubt, hesitation, and often a loss. Because the market didn't fail. You just entered before it gave you proof. Confirmation, on the other hand, changes the entire equation. It doesn't remove risk, but it reduces uncertainty. When a level breaks and holds, that's confirmation. When price pulls back and respects support, that's confirmation. When momentum continues instead of fading, that's confirmation. These are not predictions, they are validations. Now ask yourself, would you rather trade a possibility or a proven move? Because that's the real choice. Traders who rely on anticipation are constantly trying to be right. They want to predict the market. They want to call the move before it happens. But the market doesn't reward prediction. It rewards alignment. And alignment only comes after confirmation. Here's the practical side of it. When you wait for confirmation, your entry may not be at the perfect price.